The stepped-up basis. Most people think dying is the great equalizer. For billionaires, it's a tax strategy. Here's how it works. You buy Amazon stock in 1997 for $2 a share. By the time you die, it's worth $3,000. That's a gain of $2,998 per share. Under normal rules, selling that stock would trigger a massive capital gains tax bill. But you didn't sell. You held. And then you died. When your heirs inherit those shares, the IRS resets the cost basis to the current market price, $3,000. The entire gain, decades of compounding growth, vanishes from the tax record overnight. Your kids can sell immediately and owe nothing on that growth, not a penny. This is called the stepped-up basis. It was designed to simplify estate accounting. What it accidentally created was a generational wealth machine. The longer you hold, the more you gain, the bigger the tax bill that never arrives. Jeff Bezos' shares have gained over $170 billion in value since Amazon went public. Under the stepped-up basis, that entire gain could pass to his heirs completely untaxed. One rule: infinite leverage. Carried interest. Picture this. You manage a $10 billion hedge fund. You don't own that money. Your clients do, but you take 20% of any profits you generate. That's your fee. That's your income. Except the IRS doesn't see it that way. Under the carried interest loophole, that 20% cut is classified not just as ordinary income, taxed at up to 37%, but as a long-term capital gain, taxed at just 20%, sometimes less. Why? Because technically, you're sharing in the investment risk. That's the argument. In practice, hedge fund managers and private equity executives collect billions in fees every year and pay roughly half the tax rate of a surgeon or a software engineer earning a fraction of that amount. Warren Buffett famously pointed this out. He said his secretary paid a higher effective tax rate than he did. Carried interest is a big reason why. Congress has debated closing this loophole for over 20 years. It's still open. The private equity industry spends hundreds of millions lobbying to keep it that way. Funny how that works. Augusta rule. This one sounds too small to matter, but it isn't. There's an IRS rule, Section 280A, originally created to help homeowners in Augusta, Georgia, rent out their homes during the Masters golf tournament without paying taxes on that rental income. Rent your home for 14 days or fewer per year, and that money is completely tax-free. No reporting, no forms, no questions. Billionaires and business owners figured something out. If you own a business, you can rent your personal home to your own company for meetings, retreats, or events, up to 14 days a year. The company deducts the rental expense as a business cost. You collect the rent personally, completely tax-free. Set the rental rate at market rate for a luxury property, say $50,000 a day, and you've just moved $700,000 from your taxable business into your personal pocket, completely tax-free in a single year. Legally. A rule designed for retirees renting a spare bedroom during a golf tournament became a tool for shifting hundreds of thousands in untaxed income. The IRS never updated it. Conservation easement. Here's where land becomes a printing press. A conservation easement works like this. You own a large piece of land. You donate the development rights to a land trust, promising never to build on it. In exchange, you get a charitable deduction equal to the difference between what the land was worth with development rights and what it's worth without them. Sounds reasonable, environmentally friendly, except it became one of the most abused loopholes in the entire tax code. Promoters started buying cheap land, getting inflated appraisals that dramatically overstated what could have been built there, donating the easement, and claiming deductions worth 4, 5, sometimes 10 times what the land actually cost. Investors would put in $100,000 and walk away with a $500,000 tax deduction. The IRS labeled these syndicated conservation easements as listed transactions. Essentially, known tax scams. They've pursued billions in penalties, but the legal versions still exist. And for billionaires who actually own massive estates or farmland, a legitimate easement can erase millions in taxes while generating genuinely good press. Generosity and strategy rarely wear the same face this comfortably. Puerto Rico Act 60. Puerto Rico is a U.S. territory. Its residents pay no federal income tax on income sourced within Puerto Rico. In 2012, Puerto Rico passed Act 20 and Act 22, now combined into Act 60, to attract wealthy Americans. Move to Puerto Rico, spend at least half the year there, and your capital gains tax rate drops to 0. Your dividend income drops to a flat 4%. Hedge fund managers, crypto billionaires, and day traders started arriving in San Juan with serious money and serious intentions. Some brought genuine investment, others bought a condo, flew back and forth, and claimed Puerto Rico residency while living essentially the same life they always had. The IRS watches Act 60 claimants closely. Residency requirements are strict. But for those who genuinely relocate, the math is staggering. A crypto investor sitting on $100 million in gains could save $20 million in federal taxes simply by establishing bona fide residency before selling. $20 million. One address change. Oil and gas intangible drilling costs. When an oil company, or an investor in one, drills a new well, a large portion of the costs involved are considered intangible. Labor, fuel, chemicals, things that don't have physical salvage value. The IRS allows these intangible drilling costs to be deducted immediately, in full, in the year they're incurred. For a wealthy investor putting $5 million into an oil and gas partnership, that could mean a $3 to $4 million deduction in year one. Against ordinary income, at the highest tax rate, the well might produce income for decades, but the deduction arrives immediately. This loophole has existed in some form since 1913, over a century old. Originally designed to stimulate domestic energy production during wartime, still fully intact today. The oil and gas lobby is one of the most powerful in Washington. The deduction costs the federal government roughly $1.5 billion a year. Every year, like clockwork, since Woodrow Wilson was president. Roth IRA conversion. This one isn't exclusive to billionaires, but they use it better than anyone. A Roth IRA lets you invest after-tax money and then withdraw everything, contributions and all the growth, completely tax-free in retirement. The problem for most people is the annual contribution limit. $7,000 a year. Not exactly world-changing. Peter Thiel found a workaround. In 1999, Thiel bought founder shares of PayPal inside a Roth IRA at a fraction of a cent per share, valuing the entire account at under $2,000. When PayPal exploded, those shares became worth millions, then billions. Today, Thiel's Roth IRA is reportedly worth over $5 billion. Every dollar of that, and every dollar of future growth, is completely tax-free when withdrawn. The strategy is called a mega backdoor Roth. You put low-value assets, startup shares, options, into a Roth before they appreciate. The IRS taxes the tiny initial value. Everything that follows? Zero taxes. Forever. The account meant to help middle-class Americans save for retirement became a multi-billion-dollar tax shelter for one of Silicon Valley's most connected investors. The math was always there. Most people just never had the assets to run it.